Federal Reserve is trying to pump the brakes on inflation, announcing an interest rate increase of 0.5%. That's less than previous hikes. Still, it's the 7th rate hike of the year.
50 basis points to close out 2022. Article from Fox Business says the Federal Reserve on Wednesday raised its benchmark interest rates by 50 basis points or 0.5%, showing its campaign to cool economy amid early signs that stubbornly high inflation is finally starting to ease. Stay with me, guys. Even if the article is from conservative sources, they will still have to sell commercials and ads, guys. So they have to use these types of words so Americans won't run for the high hills. Let's continue. The widely expected move puts the key benchmark federal funds rate at the range of 4.25% to 4.5%, the highest since 2007 from near zero in March. It marks the 7th consecutive rate increase this year and places interest rates in firmly restrictive territory. While the rate hike is slightly smaller than the 75 basis point increase approved at the past 4 meetings, it is still large by historical standards. In addition to the large rate hike, Fed officials laid out an aggressive path of rate increases for the next year. New economic projections released after the 2-day meeting show policymakers expect rates to rise to 5.1 in 2023, then a far higher level than the 4.6% rate officials last projected in September, according to the Federal Open Committee, the FOMC. Dot plot of individual members' expectations. New government data released on Tuesday showed that the Consumer Price Index, the CPI, rose 0.1% in November from the previous month and 7.1% on an annual basis, far less than economists expected. Still, inflation remains about 3 times above its pre-pandemic average and far higher than the Fed's 2% target. So give us live perspective, editor. Roll clip. Fair use.
The Federal Reserve raising interest rates by 50 basis points to a new range of 4.25% to 4.5% as expected. The Fed saying ongoing rate hikes will be appropriate. The Fed also raising the 2023 median forecast of Fed officials went up to 5.1%. It had been at 4.6%. This is higher than market expectations for a peak funds rate. It is, by the way, right in line with the Fed survey at 5.15. 17 of the 19 officials are now above 5% in their forecast for the 2023 funds rate. None were above 5 in the September forecast. 7 officials, in fact, are at 5.40, and there's one person who's at 5.63 for all the way through 2025. The funds rate then see going down to 4.1% in 2024, 3.1 in 2025, with a long run rate eventually being reached of 2.5%. The Fed repeats it will take account of the cumulative effect of rate hikes and lags in setting policy. This is again from the statement. It will continue to reduce the balance sheet by $95 billion a month. It says growth has been modest, inflation elevated, unemployment low, and job gains robust. So it still sees that tight job market out there. It raised the GDP this year to 0.5 from 0.2. That's because of the strength we've seen in the fourth quarter, but it lowered it to just 0.5 point for next year from 1.2. Ratcheted up a bit the unemployment rate to 4.6 from 4.4 for next year. Stays there for 2 years, by the way. And it sees inflation gradually declining to 2% by 2025. So 50 basis points, Kelly, but pretty hawkish when it comes to the outlook. And good unanimity, by the way. The statement, the policy decision was unanimous. Good unanimity also, at least by the board right now, on where rates are headed, and that is above 5%.
Let's get more details on those Fed minutes that were just released. Jen Schomburger has a closer look at that for us. Hey, Jen.
Good afternoon, Shauna. No Fed officials thought it would be appropriate to cut rates this year, noting that the unwarranted easing in financial conditions could actually complicate the Fed's efforts to bring down inflation. Several participants underscoring that the Fed's median projection for rates of 5.1%, which is above the market's expectations, underscored the Fed's commitment to bring down inflation. All of this signaling to markets, we are not expecting to cut rates this year, even though you are pricing in some of that, and we are not budging unless inflation comes down. Members thought that price pressures could prove to be more persistent than anticipated, with the job market remaining so strong for longer than expected. While Fed officials saw reductions in inflation data for October and November as welcome signs, they stressed it would take substantially more evidence of progress to be confident that inflation was coming down. They noted that, quote, a restrictive policy stance would need to be maintained for them to be confident that inflation is on a sustained downward trajectory. Now, of course, the question du jour for investors, at what pace will the Fed raise rates at future meetings, having slowed down to 50 basis points from 75 basis points? Well, Fed officials not tipping their hand in those minutes, noting only that they will base decisions on future rate hikes on data and the implications for inflation and the economic outlook on a meeting-by-meeting basis.
Hey guys, it's Jose, your regular Joe Blow, keeping an eye out and my ears open to this news, stating interest rates was raised again, and the Feds will continue to raise rates moving forward into the next year, as expected. The good thing is the Feds continue to warn us with time because remember, the economy lags in reacting to each rate hike. So we have 6 to 8 months to feel what is done today. So this helps positively in moving forward due to predictability of the Feds. So guys, continue to do your research. More sources in the description below to better prepare moving forward, guys. No pivot coming so far. Hope for the best and prepare for the worst outcome. A recession, deflation, or stagflation might be coming in 2023, but I'll continue to do my best to bring you the best. Thank you guys. I appreciate your support. Always very, very much appreciated. But don't forget, guys, stay free.
It ain't hard to tell. I excel, then prevail.